Well, first of all, it's an honor for me to be here, and it's also a very special occasion, and particularly coming from a country which had a hard time joining the EU, which had a hard time joining the EMU, which had a hard time joining the SSM, and so on and so forth. And it's very generous of you to give me an opportunity to talk about financial stability here. So I'm going to talk about financial stability and macroprudential policy or policies from the perspective, where do we come from? And I'm talking about it with almost a 30-year history. But of course, 30, 40 minutes, this is not the unabridged history of stability reports. So it's sort of bits and pieces of it from here and there. But to start, I'm speaking for myself, no one else. And I do not opine on present Swedish monetary policy. I spent 22 years dealing with Swedish monetary policy, and it's up to others to deal with it nowadays. I had 29 years in central banking at the Riksbank and the IMF. I've done a number of international assignments, crisis management, and what we heard here. But what I do think is important today is that when you think about stability reports and when you discuss financial stability, almost all of it that I'm going to talk about is basically learning by doing. So all of it was done without a textbook. All of it was done without somebody else telling you what to do. So most of it was really starting with a blank sheet of paper, trying to make sense of a complicated world. And I think that is important, because there is one concept that one can call logic in use, and that's what I'm talking about. There is another when you write the history, which is what I would call reconstructed logic. And the reconstructed logic always is nicer than actually the logic in use. So I'm going to talk about three things. Where do we come from? Where do the FSRs actually come from? And I'm going to mention some issues that all of us who have done this type of work struggled with over the years in one form or the other. And I'm also going to make a few comments on financial stability as such, and the governance and the governance structures, and in some instances, actually the lack of governance structures and the difficulties that follow from that. But first of all, and this is a slide that comes from a very nice paper which is being published today, describing how things have evolved when it comes to financial stability reviews or reports, whichever R you prefer to use, showing what has happened over the years. And I have put in a red circle around the 90s, where we have the Bank of England, Norges Bank, the Riksbank, Bank of Canada, and the IMF. And this is a period when these reports started to emerge in one form or the other. And it is not, and as far as I recall, it was not in the early days a coordinated project. It was more because the time was right for doing this. So they kind of showed up in parallel, and then we read each other's reports, and then we kind of took it from there. And I have dealt with a few of these, both at the Riksbank, at the IMF, and also partly during this period when it comes to Bank of Canada. But this is a nice way of summarizing what happened and what has been added after that, and what these reports actually do and do not do, and some of the issues. And all of this you find in this nice paper, which is published today. My own story then, going back to the 80s and the early 1990s. First of all, we had general macroeconomic imbalances. Nothing new under the sun when it comes to that. We had a fiscal crisis, we had a currency crisis, and most of all, we had a systemic banking crisis. And all of this had to be dealt with more or less simultaneously when things blew up on a grand scale. And this is the experience from the 90s. Here you see lending to GDP, and what happened in the mid 80s, late 80s, and early 90s. Lending to GDP from the financial sector went up from around 80% to 120%. 40 percentage points in 5 to 7 years. And in other fora, I've said that it takes about 3 to 5 years to destroy a good bank, and here you have the answer. And you can see that. And it takes another 4 to 5 years to put the pieces back together. And this was a serious, very, very difficult event to deal with. The other part of it is, and this is scary if you look at the numbers, and these numbers are hard to find nowadays. This is commercial real estate in the greater Stockholm region from 1980 to 1993. From peak to when prices started to fall in about 18 months, prices dropped by 60%. And if you've seen that happen, if you've lived through that, then you are forever skeptical when it comes to risk weights. That's for sure. But that's a different topic and a different story. So this is what we had to deal with. Now, based on all of this, of course, then we ended up with a serious output loss. And this is in GDP terms, and this is how you actually should think about these things. This graph is wrong. It shows you getting back to normal, which rarely happens. And here comes another one, but it's the right way to think about it and why you would like to avoid a financial crisis. And this is why it matters when it comes to producing stability reports. And here comes another one, and bear with me because this is really eyeball econometrics. But basically what these graphs show is a number of financial crises in the US, Japan, UK, Korea, Mexico, and Sweden at different moments in time. What happened to growth after the financial crisis struck? And the lesson from this, and you can find this in many other countries, is that you will never get back to your old growth path. So in that respect, a financial crisis is a loss to society forever. And that's why it really pays to avoid these events if it is possible, because you have significant long-run costs when it comes to dealing with this one way or the other. So clearly the conclusion is that if you can avoid a disaster, do your best to avoid a disaster. Now, why then did we produce, and here it's called Financial Market Report, the first one in 1997. First of all, we asked ourselves, those who did the work, that we don't want to go through a financial crisis again, because there is a huge cost to society. And at a more personal level, it's an absolutely grueling work, extremely painful 24/7 for several years to put the pieces back together. So you don't want that to happen. And also that led us to the conclusion that you would like to come up with an ex-ante warning. At least somebody should tell others that we're heading in the wrong direction. Ideally, you should stop it, but that's usually not good enough because it's hard to do. And it also led us to the conclusion that financial stability matters. Because if you come from the macro side, you tend not to focus on financial stability. This issue in 1996, 5, 6, 7 was not really high on the agenda, and actually no one asked us to do this. This is what Urban Bäckström, who was then governor, and I was deputy governor, cooked up on our own. And that was the starting point. And there was from a blank sheet of paper. And we said, this was enormously painful, pure hell to deal with the banking crisis. We got to do something about this. And this is done in a central bank which does not have supervision, and which is not really expected to deal with financial stability. And here's the first report from early 1997. In that report, we also focused on credit losses, as one would suspect. Things were not in color back in those days, but you see Sweden, Norway, Denmark, Finland, everything is kind of on the gray side. But if you look at the bars, you can see and draw the conclusion that all of us ended up in a huge mess. And it was in the interest of all of us to try to avoid it in the future. So that was there. Unfortunately, credit losses are a perennial issue that always comes back again and again. And we always tend to say, this time is different. This time we have really figured it out. So just let people borrow. And usually that ends up in a problem sooner or later. There were a few other issues in there that are prescient in the sense that we talked about a systemic risk perspective. And that way of thinking about things didn't really figure prominently in those days. We also said actually that EMU implies more competition. I mean, this is 30 years ago, and we still struggle with the SSM, and the banking union, and Commerzbank, and God knows what else. We also said that EMU implies more market funding, and we still struggle with the capital market union, but eventually those will come. And what is very, very interesting, it says clearly in the report that it was discussed by the Governing Council. And that was extremely rare in those days, to have a Governing Council actually talking about stability issues. Now, fast forward. Also, what happened in the late 90s was that the IMF put together the financial sector assessment program. And the FSAPs, the short form of them, they are actually stability reports, if you read them and if you look at what's in there. And what that meant was that from the pilot 1999, and Canada was actually the first country to volunteer, roughly at the same time as they started producing a stability report, it has turned into a global product which focuses on financial stability. And that is important because that means that there is a kind of a model document that you can look at if you want to do something of this type in different parts of the world. This also has its peculiarities when it comes to starting this, because this is what I wanted to do when I got to the IMF. No one asked me to do this. I went to Michel Camdessou, and he said, start with the US. And of course, they came in last eventually after China. And then there was actually a meeting with all the department heads chaired by Stanley Fischer, and there was a tour de table. And all the other department heads, because they are macro people, said, this is not necessary. And Stanley Fischer looked up and said, Stefan, let's do it. And that was the starting point of this. What also is interesting, if you look at old documents, is that here's one called Macroprudential Indicators, Financial System Soundness. We don't need to get into the weeds and details of all of this. You recognize some of the names here, but this is actually came year 2000. And that was kind of very, very early in this process just to use this terminology. And then another part, which is dear to all those individuals who work on financial stability reports, is that here's another paper dealing with Rowan 2, stress testing in financial sector stability assessments, experience, progress, and issues. And this one is from 2003. So these issues grew on us gradually and surfaced, and were then gradually also being used by many more. And I put within parentheses here that financial sector matters also to macroeconomists. And that was really one of the early challenges dealing with these types of reports, because if you have your heart in general macro, you have sort of set financial stability issues aside until things blow up on a grand scale. And then you realize that you have to deal with it in one form or the other. Along a similar line, in 2002 comes the Global Financial Stability Report, which is kind of trying to aggregate financial stability up to the global level. Now, this is quite a challenge, of course, because how do you talk about financial stability when you aggregate everything up to that level? And that's quite a challenge, but it is also a product when it comes to one version of the stability reports, when you move all the way from super micro, which is basically individual institutions or individual markets, all the way to the global system as a whole. And it was actually Horst Köhler who asked for this, commissioned this report. And what is also interesting when you look at it is that the board discusses this. As a background, when it comes to financial stability report, we have some what I call preconditions, and that's here it's called the standard setting. Some examples of standards and codes. Then the first one, which has nothing to do with stability report, was actually the central bank code on transparency. And the first volunteer was the ECB. And I came to Frankfurt, and among others, Tommaso Pagliaschioppo was yelling at me for a couple of hours, saying that I had misunderstood everything when it comes to transparency. But I do think that things have gotten more transparent over the years. Then we have all these standards, and most people never focus on these standards, but these are important in the sense that it's kind of background work when it comes to financial stability reports, because these standards and to what extent you are actually in compliance or not says something about the plumbing at the national level. And if you're far off the chart when it comes to these standards, then you tend to have a problem in the financial sector sooner or later. Mostly people don't focus on them, but it's quite elaborate technical work to look at these. For example, accounting, banking, payment systems, securities, insurance, money laundering, and so on and so forth. Now, another one, which is basically using the same technology, which matters a lot today, is what is called the Regulatory Consistency Assessment Program, which is basically the Basel Committee keeping track of where countries actually are. And that's a nice technology in the sense that this also matters when it comes to stability reports, because one way or the other, you actually need to know what countries are actually doing. And no one asked for this either. I just did it, which is remarkable. And of course, if you're not in compliance, then one jurisdiction or another has over the years said that who the hell cooked up this? Where did this come from? Why is it that we have to be subject to this? But I do think it's a good thing. Now, on transparency, because that's part of the process always when it comes to financial stability in one form or the other, and it's quite a challenge. And over my 30 years having dealt with this, we have actually always moved towards increased openness, but it hasn't always been easy. And here is a statement by Alan Blinder in one of his papers, where he says that the way we talked about monetary policy in the old days was to say as little as possible and say it cryptically. And of course, it doesn't really work that way anymore. And in 2006, I said our job is to speak and write in a way so that everyone can understand what we are doing. And this really, really holds when it comes to stability reports as well. And we have come quite a long way. And we are, I would say, much, much more confident and bolder today than, let's say, 20 years ago or 30 years ago. But it's a natural instinct also sometimes to say nothing, because if you say something, you will always get criticized. But one way or the other, when you're in a decision-making position, it doesn't really matter what you do. You will always get criticized anyway. So you might as well be transparent. That's at least my view of the world. Now, then continue on this topic of communication. Financial stability reports are really ideally about ex-ante communication. It's really telling a story about what is going on in the financial sector and what you ought to worry about, or at least be observant about, so that you understand what is going on in the financial sector. Then there is a distinction between what are with internal communication and external communication. And we found out in the early days that publishing a stability report is very helpful when it comes to internal efficiency, because it actually forces staff members to think hard about what they want to say, because others will be reading what they wanted to say. And then that gets dangerous. And it also clears your mind, because there is a deadline and you can't rewrite the same memo 5 times, making it more bland over time. And then you have the other challenge, which is, of course, always external communication. And we heard references to that already. And external communication, regardless of whether we are talking about monetary policy or financial stability, is really to understand who is your audience. If you don't understand your audience, with a fairly high likelihood, you're going to transmit using long wave, and those who receive this stuff use short wave, and then the message gets garbled or nobody listens. And this is a serious challenge when it comes to stability reports. Then we, of course, have the whole issue of what I call here a false positive. You say that everything is fine, and then things blow up. And then we also have the false negative. You say everything is going to blow up, and it did not. And both are just as difficult to deal with. And that's because it's a perennial challenge to communicate uncertainty. And that is really, really a challenge to figure out how to do that. And this you also find when you read inflation reports, when you read weather reports, and when you read pandemic projections and other phenomena in our societies where you have to communicate uncertainty in one way or the other. Because we human beings would like to know that somebody knows. And that is really, really the challenge when it would be dishonest to say that you know. And this is really, really difficult. This is an example. I don't expect you to read any of this. This is just an example of what happened during the global financial stability when it comes to the Riksbank's stability reports, also quite a lot referring to what happened in the Baltic countries between 2007 and 8. And the key message here is that the messages that we used evolved over time, and they evolved quite a lot. And at the same time, of course, the whole system blew up in the Baltic countries, and that is quite a challenge. These reports are okay in the sense that if you look at what actually happened, we warned. And that was a good thing. So there was a lot of communication, but to little avail. Nothing really happened based on what we communicated. All of this, of course, looks okay at ex post because we can say we told you so. But actually, it's not good enough because nothing was done ex ante in the case of Sweden. And that's not good enough. So from that perspective, the whole exercise was not the reports as such, but the way the whole issue was handled could have been a lot better. And actually, during those days, the Baltic countries begged for measures, and nothing was done. And that was also a dilemma. And in addition to this, and this is, of course, always an issue in an EU context, you have all sorts of cross-border worries, and cross-border worries are particularly hard to deal with. In those days, we worried about the Baltic countries. Today, the Baltic countries worry about the Swedish housing market. So these things, sort of, the pendulum shifts over time. And this is really what I would call the Achilles heel of the FSRs. And it's very, very difficult to deal with. I don't know how to change this, but it's better to do FSRs compared to not doing them and then just struggle with this over time. The other communication is, of course, the whole issue of transparency, which I already have touched on. And the ECB paper is a nice summary of some of the issues that you find when you try to increase transparency. The Global Financial Stability Report is a good example because they actually upfront have a summary of the executive board discussion. And that is very, very rare, and it's commendable that they have done that. And let me give you a bit of an inside story, and maybe I shouldn't do it because Aino is sitting here and now she's struggling with this. Many, many years ago, I had the ambition of having the executive board actually producing minutes from our internal conversation about financial stability. We did it once, and it did not work at all. And that was because most of the executive board members did not have a financial stability background. But I do think that over time, if you publish financial stability reports, you should strive to actually write minutes, and ideally minutes with attribution, because then you actually have to know what you're talking about. And that is, of course, not that could be painful, but I do think it's the right way to go. I've held about 40 stability press conferences in one form or the other, crisis management, but also when it comes to stability reports. And it's always the same. What is your story? What do you want to say? What do you want to say? The other part of it, which is hard to deal with compared to monetary policy, is that these reports are forward-looking, and that means that there is always a lack of immediacy unless you are in the middle of financial crisis. And that means that people are maybe not always that interested, because if you say that everything is fine, then why should I read this? And that means that the time perspective is different. And that is important because it's not here and now. It's more like if you talk about climate. Basically, it's about saying no today so that bad things don't happen in the future. And this is what we human beings have great difficulties dealing with. But again, you're always back to who is your audience? And sometimes in these reports, and we heard a reference to that going from 200 pages to 100 pages, information overload. And this is very, very delicate, because how do I design these documents in such a way that I actually reach the most important readers? And that's quite a challenge when it comes to how you design them. A novel concept is the global growth at risk, which also exists in the ECB stability report. And that also actually shows how the technology has evolved over the years when you produce these reports. This is an innovation. It's maximum aggregation. And there is a potential connection to general macroeconomics, which is a nice thing, but it's very hard to communicate. And that's, of course, a dilemma in itself. But still, it's a nice way of trying to do this. And it also shows over the years how things have evolved, and how many staff members in many institutions, and academic institutions as well, have spent a lot of time trying to figure out, how do I present this? How do I make sense of this? And that's a nice way of explaining where we are today. Another example is the liquidity stress test that we did at the Riksbank already back in 2010. And this is an innovation. It's actually pre the liquidity coverage ratio and the net stable funding ratio. We probably have to reconsider some of this after the SVB debacle and others. These tests were bank specific, which has been quite a challenge in many countries and jurisdictions. This is bank maximum disaggregation. And from that perspective, it's actually quite interesting. And then one needs to be mindful of the fact that life has taught me, when it comes to liquidity, that markets function the worst when you need them the most. And models can change that. You just have to understand that. And you have had to see that happen a number of times before you come to that conclusion. And this is what it looked like. We don't need to get into the details. Here you can see Swedbank, SE-banken, Handelsbanken, and Nordea. And this is how this was done. And this is something that I think requires more work in many parts of the world when it comes to how to present this. Stress tests, again, tough topic. And in the early days, I think I actually was in this room talking about stress tests when I was a member of the ESRB. Many central bankers and supervisors have found it extremely hard to deal with stress tests over the years, and they found it extremely unpleasant to publish stress tests. But at the end of the day, you're always better off publishing compared to not publishing, because otherwise others will do the stress tests for you in one way or the other. The issue, of course, when you do stress tests, and this can be done in many different ways, so one has to accept that it can be done in many different ways. One way of doing it is top-down, because you start at the macro level, or you start at the global level, or you start at the European level. The other way of doing it is bottom-up. And when things have fallen apart, bottom-up is the only way of doing it, because then you actually have to go through loan portfolios one file at a time, because then bottom-up becomes too general. But nothing wrong with top-down in the early days. Liquidity, I have pointed out already. And the fourth one is basically scenario analysis. You ask yourself, what if? And then you see if you have enough capital in the financial sector in one form or the other. Also, which is an issue that comes back time and time again, is which markets to cover. It seemed natural in the early days to just look at banks, but you can't do that anymore. You need to cover many other parts of the financial sector as well. What is helpful when it comes to producing this is what I would call national heat maps. And then, of course, you have to agree among yourself on the degree of transparency when you do these things. And that is likely to vary both over time and from country to country. And then we have the institutional setup, and many in this room know this a lot better than I do. In Europe, who does what and why? Should we produce many FSRs? We do so today. We have the ECB, the SSM, the ESRB, the national central banks. We have national financial supervisory agencies to the extent that they're not part of the central bank. We have IOPA, EBA, and so on. And that, of course, means that it doesn't make sense for everybody to do the same thing over and over again, but we probably have to accept that over time we will have many of these reports in one form or the other. And then we have to look at the non-bank financial institutions and what is happening on that side. And that, of course, brings us into perennial data issues in one form or the other. And then we have all these new phenomena. Some people call them stable coin. I call them unstable coin. And I'm just waiting for the next disaster in this field. And what takes a completely different skill set is what is called here operational resilience, IT preparedness. And that, of course, is not dealing with what supervisors are usually trained to deal with in the past, but is very, very important because in the future, we will live in a world where nothing is on paper and everything will be digital. And then if the plumbing goes down, then you have a problem. And then the final one is, I made up this word systemicness, which is basically dealing with the issue of in the financial sector. When is a phenomenon in the financial sector of such a magnitude that it's a non-insurable risk, so that we have to deal with it as best as we can in one way or the other. Another angle is governance. We have fiscal policy, we have microprudential policies, we have macroprudential policies. Some of them are dealing with general resilience, either when it comes to lender-based or some of them are borrower-based. And then we have cyclical approaches. And when it comes to the cyclical approaches, changing the policy, that's kind of like changing the policy rate without changing the policy rate. It's doing a little bit of monetary policy without calling it monetary policy. And this is, by the way, why I do think that macroprudential policies actually belong in most cases with the central bank. For this to work, you actually have to presume market segmentation, both domestically and cross-border, because if there's perfect arbitrage, then of course everything will go away overnight, and you're basically down to one policy rate. Monetary policy then, without financial stability, the execution of monetary policy becomes difficult. We have fiscal dominance, we have financial dominance, and we have different time perspective. And this makes it hard to deal with. I'm not going to talk about fiscal dominance at all. Many others have done that. And so far, we have had great difficulties connecting the dots when it comes to connecting financial stability to monetary policy in one way or the other. And part of it is because the time perspective are so different. This is a graph from the latest monetary policy report of the Riksbank. And this is not to talk about Swedish monetary policies, just to point out the time perspective. 3 years out, maximum. That is the time perspective. There is another graph talking about financial stability and potential financial dominance. The light blue graph shows debt to income, to disposable income in the case of Sweden from early 90s to today. And as you can see, the debt to income ratio has gone up. This is the entire household sector. Older people usually don't have debt, so young people have actually a debt to income ratio, which is usually about 400 to 500% of disposable income. 75% of this is variable rate. This, of course, means that sometimes there will be instances when monetary policy issues and financial stability issues coincide. And you have to be aware of that. If you look at the red graph, the red arrow in 95, 96, that was when our banks were still a bit shaky and long rates started to go up in the US. And then we were in a difficult spot because the domestic rate had to go up and we had to ask ourselves how far. And when will the banking system run into trouble again? And then we have a bit of a similar situation now when inflation reached 10, 11% in many parts of the world. And policy rates have to go up everywhere. And then what happens in the household sector? And then these two sort of coincide, and you have to be mindful of that. But talking about the household sector here, the time perspective and the structural issues are completely different compared to how you talk about monetary policy in a very cyclical sense. So let me then finish. If things blow up, the central bank will always get the blame. And that essentially means that we have work to do. Thank you.